Good morning. Welcome everyone to this CLE on law firm trust and general books, records and accounts, best practice, and the use of electronic banking transaction and methods. I'd like to introduce Sara Jiménez and Gustavo Jiménez. We're both chartered professional accountants. Both Sara and Gustavo have worked extensively with lawyers and law firms in both Alberta and the Yukon, performing trust audits and investigations and assisting members with the proper maintenance of law firm books and records. They run a CPA practice in Alberta, Calgary, and performing forensic accounting and litigation support services, and working with small business clients, providing accounting and taxation compliance services and business advisory services. So please help me welcome Sara and Gustavo.
Well, thank you very much, Megan, and welcome everyone to our professional development session on law firm trust and general books and records. Today, we will look at best practices for keeping your law firm accounting records and also taking a look at electronic banking transactions and how these aligned or perhaps don't align with these best practices. We will finish off looking at some fraud risk encountered by law firms and some red flags to watch out for. Before we get going, I just want to make sure that everybody's familiar with the features in Zoom. So we have a feature here in the chat area, and you're welcome to ask questions as we're speaking. We will continually check the chat and pause to answer questions as they arise. Also, there is an area where you can raise your hand. And at this point, I would like to make sure that everybody knows how to use this, as we're going to go through some polling questions throughout the presentation. So can I ask everybody to please raise your hands? Great, so I see that everybody did. So please now lower your hands. Now, if you have any questions and perhaps you want us to interrupt us, also feel free to raise your hands and we will stop and open the floor to yourself. So thank you very much again, and let's start. So thank you, Megan, for the introduction today. Again, I'm Gustavo, and I have here with me my partner, Sara, and we are very happy to speak to you all today. Our agenda this morning will start with best practices for both trust and general law firms bookkeeping with, of course, illustrations. Next, we will examine the use of electronic banking and electronic transaction methods in your law practice and whether you will want to use them, perhaps none, or all of these potential transaction methods once the rules and act are updated to allow for them. Lastly, we will provide some current fraud risk factors in Canada related to law practices, providing some red flags to watch out for and tips to protect yourself. As we proceed with the presentation, again, please feel free to post questions in the chat and we will address them throughout.
Okay, so let's take a start by looking at our best practices. And these are going to cover both your general and trust records. For many of you out there, this will be a quick review, but we're just going to highlight some of the items that should be a part of your complete general and trust records. And then, as Gustavo mentioned, when we get to talking about electronic transactions, we're going to highlight some of the areas that make it trickier to follow what is required in the rules and some considerations to make if you're thinking about using electronic transactions and bankings in your practice. So this will provide us with a strong platform to refer back to in the remainder of the presentation. So right off the bat, we'd love to hear what type of legal software you're all using to record your trust and general transactions. So we know our hand raising works. So just show of hands, how many of you are using PC Law? Okay, so we have a couple on PC Law. Thank you. And again, once you're done, feel free to put your hands down. How many of you are using Easy Law? Wonderful, thank you. How many of you are using Clio? This one's definitely becoming more popular in Alberta. We're coming across it more. Okay, doesn't look like anybody here. Anybody using Cosmolex? Okay, awesome, thanks. Oh, we got one, thank you. Perfect. That just helps us to have an idea of what type of records you're looking at for reference in our examples and comments there. Anything else that anybody's using that we haven't mentioned there, feel free to throw up in the chat if you're using something, a different software that you're finding works well for your practice. We always like to hear. Amicus, thank you, Kathleen. It's always good. We always learn doing PD sessions. From the participants as well. Thank you. Okay, so that's awesome. So when we look at the starting point for our records, we have our trust receipts journal. And so when we look at our trust receipts journal, obviously lots of information that we want to have in here. The nice thing about using automated software is it often contains prompts to ensure you think about entering each piece of information that you have here. Some key items to note. Date, when we're including it in all of our accounting records, is the date that the transaction actually happens, not the date it's processed by the bank. And that's a common area of confusion, is it's a lot of people start out posting based on your bank statement, and it really should be the date that you are recording receiving the actual deposit into your bank, and then again for disbursements, the date you're writing that check and it's going out of the office. So this is one of the reasons that you perform a monthly bank reconciliation, is because the date that you transact on does not usually match the date that the bank processes a transaction. Of course, with electronic transactions, this has become a lot speedier over the years. You know, we used to have to use the overnight deposit bins, put it in the bag and wait for the next day. Now with couriers, it's quite efficient. And quite often that date is the same as what's at the bank, but not always. Method is often an area for the trust journal and both the disbursements journal and receipts journal, sorry, is an area that's overlooked. But with the growing number of options on how to move money, we can't take for granted that it's just going to be checked straight down the list anymore. So it is important to appropriately document this for your records, especially if future follow-up is required and you're trying to find, how did we get that payment again? Was it a check, a certified check, bank draft, money order, wire transfer, large value transfer system, or cash if your practice does deal with cash? Your rules do not, so the rules of the Law Society of Yukon do not require you to state the purpose for which you receive the money currently, but this can be a helpful notation to include in your trust receipts journal in case of questions or confusion in the future. It also helps for, again, when you're doing a review of even a client trust ledger card, is for quickly being able to trace through those transactions. As a busy law practice, you don't always at a glance remember what everything was, but just that a quick notation can help you trace through that. You know, say for a real estate transaction, we got the proceeds, paid the mortgage, paid out whatever was required. So you can see with the purpose, because sometimes the payee is not, or the payor is not enough for understanding that at a glance. So it can help. And again, a lot of the times with the automated software, it'll prompt you to include that, which is nice. And again, as with any automated software, you can't always override or kind of blank out or skip those fields. But again, best practice is to make sure you're thinking about and accurately filling out each of those fields. So we can see a simple example here where we have that purpose of the client funds is added in just here in the column with the client name. So not really even adding a larger space to the form, but we can see we've got the client here, and then we've got the what is the deposit received for right there. And again, column with the method. Most of the time it is usually going to be check, but as practices are starting to embrace the use of electronic transactions, we're seeing some changes there, even though technically not quite allowed by the rules yet. So, but we will talk about that. That's why we're here today. Trust disbursements journal, so the other side of the transaction, similar to the receipts journal, cannot be helpful to record that purpose for disbursement clarity. just reminding why those payments are going out. And it's nice when it comes out printed on the check as well. So it's very clear to the recipient of the check from your practice why you're getting that. Can also help, again, just with that recall of what has and has not happened on a client matter, just when we're looking at the use of the trust funds that we have. We also recommend, again, adding in the number of the document used to disperse the funds from trusts for completeness and accuracy of your records. Again, this isn't required by your rules currently, but when you're receiving in the document, whether it's a check from a client, it's a bank draft, electronic transfer, however you're receiving those funds, each transaction has a distinct number to it. And so it may sound quite simple. Well, I have a copy of what I received or the canceled check, etc. So I can always go back and find it. So much easier when we just have that information available on the face of our accounting records. So the better the information we put into our accounting system and our accounting records, the better information we have available in the future for reference to in all sorts of matters, whether it's just reviewing the client file or if it's Gustavo and I visiting you for an audit, or if Linda has some questions, lots of different reasons that you may want to or need to check back on those records. So again, just a simple example here where you'll see, again, we can add in that number with the method. So again, not adding on so that we have a huge journal that has to be printed in landscape, but rather just adding in what we've received when we've received it. What we've used to disperse the amount when we do. Again, adding that purpose in right with that client, similar to our trust receipts journal example, can be just simple additions that no matter what you're using, again, if we're using a manual system, just adding in that little bit of detail can help as well. So in inputting both our trust receipts and trust disbursements, we link each of those transactions to a client when we're using automated software. If we're using a manual system, we will have to copy those items over to create a separate client trust ledger. So whichever system you're using, this is a separate document, either prepared automatically by the software or something in addition to the journal that you'll need to be creating. So this records all the receipts and disbursements from your client trust receipts and disbursements journals and shows at all times the unexpected or available balance for each of your clients. And most of you are familiar with this because at the end of the month, when you're preparing your trust bank reconciliation, you'll need to add up all of those unexpended balances to come up with that balance of what should be in your trust account. Again, if you're doing this manually, you'll want to make sure that you have a method of adding each of those client trust ledgers together to make sure you have a complete listing each month. If you're using automated software, as many of you are, it's a nice print report and out comes the report at the date we select. Generally, a law firm itself should not have funds in the trust account. However, we know that many law firms do keep a small balance in trust, especially if they've encountered or had some experience with their financial institution not quite grasping the need for bank fees or any charges there to come from your general account and not trust. So to protect and keep the client balances whole, we often see law firms keep a small amount, maybe $20 or less, in trust to cover off any of those instances. So no client balance ever goes into a trust shortage. And yes, Grant, you're absolutely right that it is not allowed by the rules to keep firm funds in trust. But as part of being an auditor, we get to find lots of exceptions. And so one that we do see is just a very small balance. And that's why I'm saying $20 or less in order to deal with those fees. And it's usually only when a firm is having issues with their financial institution, because unfortunately, different financial institutions have more or less experience dealing with legal law firm accounts for both trust in general. And so rather than having those fees actually cause a shortage in your trust account, having that buffer of a little bit of firm money is acceptable when we're dealing with that. And then hopefully it does get smoothed out. I do know that in all cases that doesn't happen. And unfortunately, it can be a learning curve for the financial institution, depends on what's happening. If you do engage in that practice and your law firm keeps that small balance of funds in trust for that purpose, there would be no acceptable other purpose for having those funds in um, sorry, a best practice for having that. If you do keep those funds, you do need a separate client trust ledger for this. So again, if you're using automated software, you would have to create one as part of putting that money in trust and recording any bank adjustments from it. However, if you're doing it manually, we do see sometimes that law firms discount that and don't create a separate trust ledger, just assuming that that's law firm funds. But that would be required the same tracking as it does for all trust funds. So keep a separate client trust ledger, track out the bank fees, and then if there a question ever comes up as to why you have that balance in trust, it's very obvious that it was there to protect or safeguard the balance in trust. Benjamin, you bring up a point, a strange area, because some law societies do recommend it as a best practice and others don't. And we definitely have seen in looking at rules and recommendations across the country, there is some a little bit of difference here. In general, the idea is keep any law firm funds outside of trust. But again, for protection of trust funds, if you're having some issues, then it does work as a protection for that. Some other best practices, including keeping a separate trust ledger for each and every client matter, not just each client, to really make it distinct each of their separate transactions. And we'll talk about transferring funds between client ledgers shortly. As well, keeping a separate trust ledger for each separate interest-bearing account held by the practice can be helpful as well. So you separately account for the movement of that fund from your pooled trust account out to a separate interest-bearing account, and then at the close of the matter or the close of that account back into the client matter. So having distinct and separate client trust ledgers, well, yes, it creates more documentation, but at the same time helps a lot with clarity to ensure that there is a distinct flow for each of those separate matters. Again, very simple example here where we can see in the ledger, it's summarizing for a single client, trust receipts and disbursements with the same or similar details that we have, and it pulls straight from usually the trust receipts and disbursements journals. Again, if you're using automated software, if not, if you're using a manual method such as Excel, you need to make sure that you have all of those details still here in that trust ledger card where you're replicating those transactions again. Okay, so something that's definitely a selling feature for the automated software that most are using these days because it reduces the amount of duplicate work. So recording all those transactions a second time so that we have all of that nicely in your records regardless. Another question from Benjamin. What about money on behalf of a third party for a client linked to a matter where they have money in trust? Is it best to have a separate ledger? If I understand, you're asking about a payment from a third party for a particular client. So that would be for the client matter. So we track by client matter. So we would just, again, that's where we're adding all those details of where did the money come from? So if it came from third party, we would detail that. And you're ahead of me, Benjamin, because we have some slides and some tips on dealing with third parties on client matters. So maybe hold on to that, and we're going to circle back to that idea shortly. Again, one of the key features on a client trust ledger here is on the right-hand side of this example, and that's that unexpended balance. So we can always see that, yes, the balance is positive and allows for that tracking. So we always know exactly what's left there. And that having it that up to date is so important. One of the areas Gustavo and I see issues with practices is when they go with a guess on what they think is in the client trust ledger and quite often use that balance that they think is there to pay themselves, and it ends up causing a trust shortage. So again, best of intentions, but the best practice is to always confirm what is in that client trust ledger before making any payments each and every instance. So if we do, again, mentioning that it's nice to use separate client ledger cards for each individual client matter, we would use a trust transfer journal. And this will document each transfer between clients or client matters. So it could be a transfer for the same client or between different clients. Often that can happen perhaps on a real estate file where you're moving from seller to purchaser. If you're acting on both sides, that's one instance where we see that. So it's a further best practice as a part of documenting these trust transfers is to ensure that clients sign acknowledging this transfer through trust rather than a disbursement via check or other means. This helps protect from future questions. Definitely helps when the auditor comes and wonders why money is moving between unrelated matters. And or within clients with multiple matters with your firm. So just a best practice there to get that acknowledgement into your files. Again, can be as simple as a direction to pay that acknowledges that the money is transferred from one file to another. Again, just a simple example there where we're noting client that's receiving the funds, client that dispersed the funds, date of the transaction, and so important that reason for that movement, so that that's recorded the why. Because sometimes we do something and it makes sense at the time, and then we go back to look at it and can't quite figure out why we did that in the first place. So documenting those reasons when we do it, definitely something we as accountants always need to put in our files is the thought process when the activity is occurring is so important. So for the general side of things, keeping your general records up to date is as important as keeping your trust records up to date. So important to be aware of the balance in your law firm and available to keep your business going as business practitioners. Often one of the first signs of a problem with a law firm in our experience is a delinquency with recording general law firm transactions. And another one is a mingling of general transactions with personal transactions. So important to keep, we all know to keep trust and general separate, but also to keep general and personal separate. So we have distinct records for what is related to our business. We want that same or similar information that we recorded in our trust receipts journal. Of course, we don't have a client that's necessarily involved, but we do want to note from whom we're receiving money and the amount you received. Again, can be a best practice to add in purpose, payment of fees, or was it an unrelated to fees receipt? So again, we have a sample ledger card here available where we can see receive fund or source of funds where we've got the invoice number clearly linked in there. And that's so helpful to be able to trace back which invoice is being paid with those transactions. For a practice that is perhaps not receiving retainers ahead of time or not working with trust funds and just has a general law firm account, really helpful again still to note what the invoice or what the matter was for. So payment for a will or payment for a corporate registration, whatever the situation may be, helpful to note that in your journal here, again for clarity and again to understand where things are going. The nice thing as well is having that detail in your general receipts journal is when you're reviewing from a business perspective, is having an understanding, where are you making your money? Okay, so, okay, you might guess, and we definitely in speaking with practitioners find, I think most of my practice is in this or that. Having that information available and being able to tally, this is how much I'm making for wills, here's how much I'm making for real estate, or whatever the practice may be. The more detailed, the better business information you have, which is helpful for making decisions about your practice and areas you may want to or may not want to focus in. Again, important to have a general disbursements journal. And yes, many of you are thinking, isn't this all one journal? Yes, quite often, if you're using automated software, it's a trust journal and a general journal that encompasses both the receipts and disbursements. A lot of the rules and terminology does date back to the fact that it used to all be the one rate system and we were doing things manually and recording things multiple times. And we still keep that format because it is important to focus that different information is required for either a receipt or a disbursement. Again, for disbursements, really a best practice to keep personal transactions out of your general account and instead pay yourself from the business for all that hard work you're doing and then conduct these transactions from your personal account. When using your general account for personal transactions, one of the concerns that comes up when we do an audit is a reluctance to show us your general account because it is a mingling of those. As soon as you include those transactions in your general law firm account, they become a part of your business records and for the rules are subject to review by the Law Society and its auditors. Regular payments, such as a salary or draws from your business, allows for clear distinction of what relates to your practice for evaluation of your profitability and success versus what you require for living expenses. We also regularly see businesses misrecording relevant business expenditures when they're mixing what is paid personally with what is paid by the business. This could have a missed opportunity to appropriately deduct items for tax purposes. And I bet you didn't think we were going to be talking about taxes today, but it is tax season. So we had to throw something in. And what I mean by that is sometimes an individual, maybe they're paying for their cell phone personally, but they're paying their home rent out of the business. And so we can allow for some confusion by yourself if you're preparing your own tax return annually or by your accountant, more questions. And it's more money actually for your accountant to decipher what goes where. And they don't always know all the things you've paid for personally on behalf of the business. So you don't want to be paying more taxes than needed. So good to keep everything business related in one pool, everything personal in another. Again, just another sample disbursements journal example here, where we've got the person to whom money is paid to, and again, particulars, that why. Really nice to have in the journal what's required. So again, just going back, not required specifically, we've got date, method, number of document, person, and amount. So that particulars isn't required by the rules, but again, a best practice to have that information there. Definitely helps remove some questions that even you might have in reviewing your own records. Now, this next one is not required by the rules, but again, those of you using automated software such as PC Law will find that you can automatically print this because all the information is already included in your software, and that's a client's general ledger. So this is separate from a trust ledger where we're tracking client funds that we've received and disbursements on their behalf. This is a general ledger that could allow us to track disbursements that we've made on behalf of the client, fees that we've billed to the client, receipts on those fees from the client, and showing just those general transactions that happen outside of trust. For those of you not using trust at all, this is a nice way to track out what happens with individual clients, ensures that any disbursements that you as a law firm are making on the client's behalf are captured in their invoices and tracked out again to make sure that we're recovering those all, which helps you stay in business as a client. So an example here where we have, again, dates, some particulars with respect to what happened on the client matter. So we've expended, so here we have a disbursement for registration, then we have some fees with the related sales tax, and then that full amount becomes the amount of the invoice. So those two amounts together become the total amount billed. So we do often find that firms that aren't appropriately tracking disbursements or expenses by client sometimes misbilling those out and therefore recovering them as a part of the client work. So nice practice to make sure we've got that data on file. We can also see this is tracking the invoices created for a client matter. Again, many softwares already do this. Some of them you can also include hours to date on the file so you can see where you're at with time on the file versus how much you have in a retainer. And some of the Programs, again, such as PC Law, can print both the general client ledger and trust ledger in one report, where half of the page is the general and half of it is the trust transactions. So at a glance, you can really see everything happening through your practice on behalf of that one client. Okay, so that's our bank account, 2 sets of journals, and how they relate out to our client matters. Looking at our, again, as a business practice, we do, and you're required to have a billing journal. Now, this can be as simple as the binder of all invoices rendered to date, hopefully in chronological order. And for those, again, using software to produce your invoices, can just be a record that can be printed showing all invoices from the practice, noting fees charged, any billing of disbursements, the date that the invoice was rendered, who that bill is to, and whether or not we've received payment for each of those. So sometimes, again, if you are using the more manual method of compiling your invoices in perhaps a binder or another method, is making sure that you're tracking that payment received, because it's important to always have an idea of collections. Again, you're business people, so having an idea of what we call your accounts receivable at any point in time, which is how much of your invoices are outstanding for review at the end of each month. So having that information available allows you at a glance to see who still owes you money and where collection efforts need to be spent. May sound quite simple, and you think, oh, my clients pay. Well, sometimes it can take some follow-up. If we didn't have enough of a retainer or whatever the situation may be, and it is important to collect for the work that you have done. So just again, simple example here of what a billing journal could look like with dates, invoice numbers, client, amount billed, total billed. We would also add in a column to show payment when it's received, so you can see what is outstanding at any point in time. So speaking of collections on our accounts receivable, we can end up with overdue client accounts. Depending on your practice and your procedures on following up with this, you may not have to deal with this. And some of you, this could be a headache that you are wrestling with. So before or within a reasonable time after beginning to represent a client, lawyers should generally be providing client with as much information about the expected fees, disbursements, and if your firm has any interest policies with respect to delinquent accounts, and presenting this to the client in writing as is reasonably practical in the circumstances. This policy would include the basis upon which your fees will be determined. So something like hourly rates, projected time, whatever you want to include for details. Sometimes, despite confirming information about fees, disbursements, and interest in writing, like many business people, lawyers often can have difficulty securing prompt payment of their accounts by clients. In order to improve success in collecting on overdue client accounts, you may wish to consider implementing a collection policy that addresses some of the items noted on the slide, such as, what does your firm consider overdue? Is it 30 days, 60 days, 90 days? Do you want to charge interest on accounts after a certain point in time? What is the follow-up process when account becomes delinquent? Is it a phone call from yourself or from a staff member? Is it an email reminder? Is it a formal letter? What is that process? So should be documented so all in the firm are aware and that regular follow-up can proceed. Who is going to be responsible at the firm for this follow-up and how often? What types of payment method will your firm accept? So that's also important to let clients know up front what you will and will not accept. Will you charge for service fees? So that's something if you're using credit card payments, etc. As we know, you get charged a fee for that. Most businesses write that off as a cost of doing business. Other businesses charge for receiving funds by that method. What will your process be if you ultimately cannot get payment from the client? So important to have that as a documented business procedures for your firm. Regardless of whether collection policy is in place, you'll want to delegate collection of overdue client accounts, or you may delegate collection of overdue client accounts to staff, but you do ultimately want to be supervising such work to be aware of where you're at and what the client response is for that. So just a little general business practice to keep in mind. So moving on to your monthly requirement with respect to bank reconciliations. And we're going to focus first on the trust bank reconciliation, and then Gustavo is going to go through some procedures that can be used in reviewing both your trust and general bank reconciliations, which again, should both be prepared monthly and be up to date. So again, when preparing a trust bank reconciliation, you should have an established process, almost like a checklist for going through that. And again, whether that's for yourself as a member or for the accountants in the audience or for paralegal, whomever's preparing that bank reconciliation, we definitely see responsibilities lie differently with each firm. You'll want to have a process. So something such as is documented on the slide here, where you want to look at the bank statement and ensure that for the previous month, noting any discrepancies in the accounts between checks that have been returned or processed through the bank versus those that haven't. Then you'll want to compare out to your trust disbursement journal and identify any checks or payments that you have issued that have not yet cleared the bank. List outstanding checks that have not processed through the bank by check number, date of issue, payee, and amount to get a total amount of outstanding checks for your bank rec. From your deposit book, you want to check off all the deposits versus the bank statement, noting any discrepancies. So maybe there's been an automatic transfer in that you hadn't noted already in your records. We'll need to make an adjustment for that. And then we'll want to look at our trust receipts journal and look at, again, are there any that didn't make the bank statement, and follow up on those. Anything outstanding needs to be listed with its details as an outstanding deposit. Again, tends to be a rarity these days with outstanding deposits because of the nature of banking and electronic transactions. We find that outstanding deposits are extremely rare to see on bank reconciliations. Yes, sometimes at month end, you can have a little bit of an overlap or a weekend, but for the most part, they've definitely decreased over the years. We'll want to list out if there's any bank errors or posting errors. And we'll want to note those out individually because we should be able to identify each and every error or discrepancy in balancing out our bank balance to what should be in the account versus which is noted in our trust journal. So again, that trust journal encompassing all the transactions as they have happened in the practice, the bank statement noting what they've received. We're doing a comparison. We don't assume that they're going to be the same. Sometimes they can be, but if we're lucky, but sometimes issues happen. Sometimes the bank makes an error. Sometimes we make an error or a typo when we're inputting something. Very easy to switch up two numbers or flip them. And we want to make sure that we're catching any of that as soon as possible. And then we want to make sure that the balance that we have on the trust bank statement is adjusted for any outstanding checks, adding in any outstanding deposits, adjusting for bank and posting errors, and then we should come back to our reconciled trust bank balance. We want to compare that reconciled bank balance against the client trust listing. So again, we want all those unexpended client trust amounts, and we want to total them out and compare those two balances. You should have, as a part of your bank reconciliation package each month for trust, a copy of your client trust listing with that, so that that total is verified between the bank, what's in your trust journal, and what's on that trust listing. So comparing that three-way match there is important. If the amounts are not the same, you must find and correct the discrepancy. Obviously, it'll be outstanding for that month end because we're doing these after the fact, but those posting errors should be done or corrected before your next bank reconciliation. Grant, you made a comment here. Pretty sure that credit card agreements forbid charging the client customer a service charge for taking payment by credit card. I don't know that that's the case. I know that various businesses do that. So I definitely, that falls outside of my expertise. So I apologize. I don't have a definitive response for that, but definitely something you can check with your bank on if that's a firm practice, just to double check on what their policies are. Thank you, Grant. So again, here we just have a very simple look at a trust bank reconciliation. Again, we always start with that bank balance and then adjust for what hasn't hit the bank yet, but we know was transacted by our law firm. And then here we have an example of a bank error where we've got a transposition 87 instead of 78. And again, making sure that That's, again, not the law firm's fault, but we should make sure that we're getting on that immediately and having the bank make the adjustment at their end. So excellent practice is to have on the face of the bank rec the notation about when that was corrected. So it's very clear that it has indeed been corrected. We don't expect to see and don't like to see bank errors or posting errors carried forward month after month. And quite often they are very small amounts. So it kind of seems like a pain to spend all this extra time on them. But especially when we're dealing with trust funds, it's non-negotiable. We need to make sure that balance is kept whole. And when you're dealing with your general bank account, I would argue that every dollar of your own money is important as well to manage. So really important to make sure you're tracing back each of those amounts that are other than a check or deposit that we know we made for the business, and and making sure that we do balance out between, again, the bank, the journal, and that overall trust listing. So we do have another question for the group is, how many of you have a formal process for reviewing your monthly bank reconciliations, both trust and general? Again, just show of hands. Awesome. Okay, I like to see so many hands there for a formal process. Thank you. And now Gustavo's going to talk about a best practice for that.
Great, thank you, Sarah. So let me start this part with what's the purpose of a reconciliation? Obviously, it is a very important record and key internal controls over the firm's assets, providing proof that there are sufficient funds in trust, and it is comparison of what should be in trust to what is actually in trust. Now, let's take a second to think about our personal bank accounts. If I was about to ask you how much do you have in your personal bank account, I think you will have a rough idea of what you expect to be in there. Next, you will log in online and you will want to see that that amount corresponds. Now, if it differs, then you will take a look and investigate accordingly. Did a payment go out you didn't expect? Or was it a bill less that it was you or you were anticipating, excuse me? Or did you receive an email transfer that you did not know was coming? This, in essence, is a bank reconciliation, knowing what is in your bank account compared to what is actually in your head. But in the world of your firm, it will be what's in your bank compared to what is listed on the books. Now, coming back to the purpose of your reconciliation, firms can locate mistakes in the books or the bank. We can track problematic transactions, such as automated pre-authorized debit that perhaps were inaccurate. Lastly, it gives us the opportunity to identify fraud or accounting errors. Your ability to recover stolen funds or missing funds from your financial institution may be affected by the length of time it takes you to notice and report these inaccurate withdrawals. Now let's go through some specific steps for a bank reconciliation. So first, has the comparison been completed on time? This is an important step. Second, are all client trust funds included from the sources held by the firm? Third, are the balances noted from your financial institution documentation correct? Fourth, and this is extremely important, is the arithmetic correct? Fifth, are all reconciling items other than checks and deposits supported by documentation or explanations? 6, are all reconciling items cleared between the month? 7, are there any stale dated checks that have been flagged for follow-up? It is important to note that if you are reissuing checks, the original check should be revised or received back from the client or canceled with your financial institution to ensure double payments are never made. 9, ensure that there are no trust shortages. 10, ensure that the amounts in trust for each client agrees to the ledger cards. The last one here is, are there any client accounts that are or have not had any activity in the last year, or a set of time frame that your firm has a following up, such as for this type of accounts. Now, the key takeaway here is to show that you have been there. It can be helpful to put ticks against what you have checked and then sign and date the reconciliation statements as evidence that the reconciliation have been reviewed. The person preparing the reconciliation statement should also sign the form as a best practice. Somebody needs to check the checker. The reason is the reason is no single person should be able to control the entire process, as this is a way to perpetrate a fraud and conceal it. I understand that for small firms or sole practitioners, all the tasks cannot be segregated, but this is why completing a thorough review of both the trust and the general bank reconciliation package is a key to safeguard not only your client funds, but also those of your firm. Now, you should record the following information on all your copies of trust deposit slips. First, the date you deposited the funds, your firm's name if it's not pre-printed, your bank account number if it is not pre-printed, excuse me, source of each receipt, related client, and of course the amount. You should also ensure that the teller stamps each deposit slip. If you use an automated teller machine, attach the ATM receipt to the corresponding deposit slip or add the source and client reference to the ATM receipt and keep it with your deposit slips. You should record the following information on all your copies of your general deposit slips. Again, the date you deposited the funds, your firm's name if it is not pre-printed, the bank account number, the source of each receipt, the related client if applicable, and the amount. Now, if you have cash receipt, for each cash receipt you received in your practice, in addition to recording it in either your trust or general receipts journal, and either the client trust or general ledger, prepare a duplicate cash receipt with the date you received the cash, the name of the person who gave you the cash, the amount of cash receipt, the name of the client for whom you received the cash, the file number if you have one, your signature or that you're authorized designated, and finally the signature of the person who gave you the cash. It is always advisable to subsequently number any accounting documents, so your cash receipts should be numbered. Give, of course, one of the copies of the receipt to the person who gave you the cash and keep one copy for your accounting records. You may also want to prepare the receipt in triplicate and keep a third copy in the client file. You should also use reasonable efforts to obtain the signature of the person who gave you the cash. You should be wary of accepting cash from someone who does not want to sign these receipts. Keep in mind that your staff may be reluctant to accept responsibility for receiving cash payments. If you decide to make it a policy of your firm not to accept cash or cash over a certain amount, be sure to notify potential clients in writing before accepting the retainers. Here is a simple example of a duplicate cash receipt. Buying a triplicate carbon copy book from your local office supply store is a simple and effective way to track this type of documentation. In this example, you can see has the receipt number, the date, received from, the amount, on behalf of, file number if you have one, and then the signatures of the person who gave you the cash and the person who has received the cash. Now, cash means current coin between the meaning of the Currency Act, notes intended for circulation in Canada issued by the Bank of Canada to the Bank of Canada Act, and current coin or banknotes of countries other than in Canada. Note that draft, money orders, electronic or wire transfer funds are not considered cash. Lawyers may only accept less than a total of 7,500 Canadian dollars with respect to any one client file. This includes clients or any third party providing cash on behalf of a client. A lawyer is permitted to accept less than a total of 7,500 Canadian dollars, regardless of how many clients he or she represents in the matter, because the receipt of cash relates to one client file. Now, a lawyer who receives, contrary to this, a lawyer is permitted to accept, I just lost my train of thought here. A lawyer who receives foreign currency will be deemed to have received it in the amount as converted into Canadian funds. Now, when a lawyer receives cash with respect to a client matter, again, he or she is obligated to make reasonable efforts to obtain the signature of the person from whom the cash was received. He or she, his or her inability to secure a signature after making reasonable efforts to obtain one does not preclude the lawyer from accepting the cash. If he or she decides to accept the cash, should clearly note that the individual providing the cash refused to sign the receipt. Whether you accept or will accept cash is a policy issue that should be decided by the lawyer or the firm and should be communicated to the clients at the outset of the retainer. Lawyers may also wish to consider including as a term of their written retainer agreement the form in which payment of retainers and fees will be accepted by them. There is no such a prescribed method of withdrawing cash from either the trust or general account. The simple method for a lawyer to do so is by a way of withdrawal slips, complete in person at his or her financial institution. The lawyer should obtain a duplicate withdrawal slip on which the client file number and the purpose of the withdrawal should be noted for his or her financial records. These methods provide the best audit trail and best practices. Lawyers are prohibited from writing a trust check payable to cash, and if a lawyer has properly coded his or her bank card for deposits only, he or she should be able to withdraw funds from trust using an ABM. Though there is no prohibition against withdrawing cash from the general account using these methods. The use of a withdrawal slip at the financial institution remains the best method available. Now, if a lawyer is uncomfortable with withdrawing cash directly from the trust account, they can or they may withdraw cash from his or her personal account and may then reimburse him or herself from the trust. Regardless of whether the funds for cash refund came from the trust or general account, the lawyer should have the person receiving the cash sign a receipt. If the receipt of the cash refuses to sign the receipt, the lawyer should have a witness present to document that the cash was provided to the individual. Now let's talk about valuable property. If your law firm holds valuable property in trust for clients, it is appropriate to keep a record similar to how you will track any client trust funds. In these records, you should include the information noted here in this slide. Properties to be included in this record should be mortgages, transfers, or other instruments registered in the licensee's name in trust. This includes mortgages other than investment securities held in trust by a Canadian or other business entity controlled by a licensee, licensees, or a firm and or the spouse of the licensee. stock, bonds, or other securities in bear form, jewelry, painting, furs, collector items, or any variety of saleable valuables. Any property that a licensee can convert on his or her own authority to cash, pretty much. Properties not to be included in these records are, for example, term deposits, deposits receipts, savings accounts, or similar deposit accounts maintained for individual clients at a charter bank or registered trust companies. These are trust money and must be recorded in the financial accounting records. Wills, securities, registers in the name of a client, corporate records, corporate seals, etc. These properties have value to the client and licensees must exercise care in keeping the properties, but they are not properties that can be sold or negotiated by a licensees. Licensees will maintain lists of these properties, but this list must be separate from these records. In this slide, we have an example of how to document valuable property held in trust. Again, you will have an area for your client, description of the property, date received, received from, value or estimated value, given to, and date given away. So now lawyers are able to receive payments from a third party on behalf of a client. However, because you're not required to accept a third party payment on your client's behalf, you may suggest that the funds be provided directly to your client so that you may avoid dealing with the third party completely. If you choose to accept the payment from a third party on your client's behalf, prior to doing this, it is best practice to ensure that, one, your client and the third party understand that the third party is not also your client. Two, your client and the third party understand that your client matters are confidential and that no information will be released to the third party unless your client consents to be disclosed. And third, that the client and the third party understand that your obligations are to your clients if a dispute arises between your client and the third party. Also, you obtain your client's advice instructions regarding the refund of any unused portion of any retainer fee paid by the third party, if that was the nature of the payment. You should also document the retainer fee payment and refund arrangements in a retainer agreement with or an engagement letter sent to your client, if, of course, that was the nature of the payment. Lastly, you should obtain your client's consent to document the arrangement in a in a letter to a third party. If you unexpectedly receive a third-party retainer payment, for example, because your client is in police custody or otherwise unable to obtain or provide the payment personally, or payments from an outstanding invoice, you should always make efforts to discuss these issues with the client before accepting the payment and should confirm with the client's instructions in writing. You may also be considering including in your retainer agreement a standard term that addresses the payment of a retainer fee or an invoice by a third party should that need arise. You must maintain confidentiality regarding the client's matter unless the client has consented that you disclose of confidential information to the third party. Providing payments does not entitle the payer to the information regarding the client matter, including the future interim bills or a statement or final statement of account. However, it is prudent for you to provide the third party or payer with a receipt of the payment you have received. Now, if the payment arrangements was ongoing and the third party stops paying or no longer agrees to provide payments, you may only withdraw from representing the client or no payments of fees, for not payments of fees, right? If the event that you did not obtain advance instructions from your client about the refund of any unused portion of the retainer fee paid by the third party and a dispute arises where you cannot determine who should receive the refund, you must speak with the Law Society for direction. Now let's move into bookkeeping assistance and training available. Theft by staff is on the rise and it is not covered under your legal insurance. The recurring profile is usually a small and often successful firm where the firm's partners are too busy practicing law and are experiencing a significant life event. Management of trust accounting is advocated to a single staff member and with little, if any, oversight by the lawyer. The lack of oversight, ironically, is sometimes a product of the trust the lawyers have in their staff member. Many of the thefts are not that sophisticated and could have been prevented but by relatively small internal controls. As lawyers, you can delegate certain tasks to firm's employees, but any delegation might be made with the appropriate degree of oversight. We stress that it is the responsibility of the lawyer, not the bookkeeper, not the paralegal, not the office manager or the accountant, to safeguard client funds. The lawyer is responsible for staff misconduct, including theft from trust. You may face civil liability for the loss of your client's funds entrusted if you're unable to make restitution. Since theft by staff is not covered under your legal insurance, we always recommend obtaining employee theft coverage. Another way to protect your practice is to perform background checks for new employees handling trust funds. This can include a criminal record check or a credit check. It is also important to ensure that your bookkeeping staff has legal experience, as this is different than ordinary bookkeeping. If an experienced bookkeeper is not familiar with your software, software companies such as PCLaw and EasyLaw are offering various types of training on their software, including online options to assist bookkeepers in familiarizing themselves with these unique products. And I'm going to pass it back to Sara to start talking about electronic banking and transaction methods.
Perfect. Thank you, Gustavo. So we know we have many bookkeeping staff in the audience today, and we do include them in understanding and sharing the discussions with practitioners, ensuring that you're working with them, you're on the same page with what is required and whose responsibility the information is, as we know that members rely on your expertise and input into the practices and setup of their books and records. So when looking at electronic banking and transaction methods, it's important for everyone to be on the same page with what is available or what can be done versus what's required in the rules right now. And we do understand that the rules and the act are being updated to look at electronic banking and transaction methods. And it's definitely something across the country that all law societies have looked at or are in the process of looking at and are continually working to adopt best practices to, again, maintain the security of the funds handled in your law practices. So we're going to take a look at how the use of these electronic methods can affect the records of your law practice, and whether that's for what you're doing right now, because I know some practices have already started using some of these transaction methods, and or something you want to consider for the future, or something that you're not going to touch at all. So how many of you are using electronic banking at all in your law practice? Show of hands. Perfect. Honestly, thank you. That's helpful to see. So it's definitely a few of you that have been already entered into this realm. So just as a basic, we know that legal practices can make use of various electronic devices and means of performing transactions. Practices regularly use a variety of computer systems to ensure efficient and effective work is done. And without our computers, where would we have been in this past year to get any work done, as we have been working remotely and dealing with each other remotely as we are today? Firms need to make decisions on what is acceptable technology for their practice and ensure appropriate security is placed on the devices being used to handle law firm information, especially dealing with client information and trust funds. If a firm is allowing for remote access, then it's important that the same security exists to protect information on devices used remotely, such as tablets or smartphones. Often, employees can set up Microsoft Outlook email on a personal phone to keep track of emails. And it sounds great, and it's great to be efficient and up to date with what's happening here. However, if that's a personal phone or smartphone, this likely has no security on it, and the information contained in those emails could easily be accessed by anyone in possession of the phone or tablet used to access that account. As we will see on the coming slides, this could include email receipts or disbursements of trust funds or confidential client information. So firms need to set up protocols for access to their firm information, as well in particular for access to trust and general bank account information. Whether the firm is comfortable using email, text message, websites, or financial institution apps or applications, a firm may wish to make use of all, none, or some of these access methods, and it's important that the risks and rewards are considered. For instance, using a banking app to hold information or allowing a website to store login information can then allow for that device to access your bank information regardless of who is in possession of the device. When using text messages and smartphones, it's important to consider all those documents that we just talked about and the ability to save and print or keep a PDF copy of any transaction records, including the unique confirmation numbers from Interact transactions, which can be conducted via text message. So if we receive that text message on a smartphone, we need to have a way to get that text message into your trust and general records as a bank source document. So those all of those different screens that are generated from using electronic transactions, which we'll talk about, are important to make note of because they take the place of that deposit slip or that canceled check that we're familiar with. And each has a unique number attached to it that becomes the follow-up place for any issues with that transaction. As we know, computers and electronic transactions are not infallible and problems can occur. We need that documentation. You need those confirmations in case you do need to hunt down funds, either a missing receipt or disbursement from your bank. So what can we work with here? We can have electronics and deposits and withdrawals that take many forms. So we can use e-commerce, members can use e-commerce methods to conduct business, where doing so allows them to comply with their professional obligations regarding client funds, trust accounts, and the general accounts, keeping in with the Law Society's current rules and act. So again, those are being updated, and what we find is some are interpreting the rules and language therein to make use of electronic transactions in their practices. Payments via third-party e-commerce provider are typically transferred from the provider's holding or clearance account to the account designated by your law firm and are usually subject to a service charge, whether that's a monthly flat fee, a fee per transaction, or otherwise. This is payable by you as a cost of doing business. For payment of client accounts for services that have been rendered to the client and for which a bill has been delivered, there's no prohibition against accepting payment by this method to your general account. Such payments would be transferred from the provider's holding or clearance account to your general account, and any related service charges would also be drawn from your general account. Prior to entering into any arrangement regarding payments to your general account through a third-party provider, you should also consider whether the security measures offered by the third-party provider will allow them to maintain client confidentiality. You should discuss with the provider the level of security it offers for the service during any given transaction and the risk of disclosure. If the third-party provider will have or require regular access to basic client information, you'll need to get the client's consent prior to disclosure and should consider including a confidentiality clause in the third-party provider service agreement. And we bring that up because we take for granted often that we're using our bank or financial institution to conduct transactions. But when we look at something like an Interact e-transfer, Interact's a third party. It's separate from your bank, and they're allowing the bank to license their software, their security, their system to conduct these transactions. So, though it may be permissible for lawyers to accept e-commerce payments into a general account from the provider's holding or clearance account, we should really look at the process used by your financial institution when dealing with these third parties, because we should not be accepting payment of retainers or retainer fees via that method, because usually we would like to see retainers or retainer fees deposit directly into your designated mistrust account that's held at the financial institution, with its earning interest at the prescribed rate payable to the law foundation and meets the record keeping requirements of the law society. So retainers or retainer fees that would be deposited to an account through the third-party service provider would not immediately comply with those requirements. So where there's a holding or clearance account offered by the third-party provider, we have to have an understanding of what that transaction looks like for our financial institution and determine whether or not we can accept a retainer payment or payment into trust via this method. Okay. Similarly, it's not permissible to make all deposits to your general account and then transfer the appropriate amounts to the trust account. Trust amounts should be set straight into trust, general, straight into general. Okay, so understanding again your financial institution setup for e-commerce transaction is important to assure you are in accordance with the rules and act. Some methods of electronic banking include, as mentioned, Interact e-transfers, remote deposit capture, automated teller machines, debit and credit card deposits, and the use of electronic payment wallets. Okay, many have likely been using ATMs, automated teller machines, and or debit and credit deposits for some time, but still doesn't hurt to look at some best practices over the use of those again. So again, using Interact e-transfers requires considerations in using this type of technology to electronically transfer funds from trust accounts, provided that minimal precautions are put in place. Ideally, the software should require two persons to effect the transfer. So one person, such as your bookkeeper or administrative staff, identified by a password or other means, can input the transaction details required. And a second person, identified by a separate password, should be the signatory member on the account to authorize the transaction and actually allow for the distribution or receipt. System must generate a confirmation of the details of the transaction to confirm that the particulars of the transaction were properly conveyed to and received by the financial institution. So we need that same level of documentation that we talked about earlier with our best practices, detailing date, client or payee, purpose, amount. All those details should be on the face of whatever confirmation we can obtain. Even if you do not plan to transfer funds from your trust account electronically, you may want to take advantage of internet banking to be able to view your trust account online at any time and to assist you in completing your monthly trust comparisons on a timely basis and not having to wait for those physical bank statements to come through. So something to consider is access. What kind of access is available? Who's able to have that access? Again, when you set up your trust account, it's only a member or members, depending on the firm size, that have access to, signing authority on that account. We want to make sure that if we're giving read-only access to another person in the firm, that it is indeed set up only for viewing and transactions cannot be conducted through such an account. When we're accepting a direct deposit to trust by a client or third party, we have some additional considerations to make. This is a method some use instead of an electronic transfer. So this would be a situation where we would be permitting a third-party payor to deposit funds to our trust account directly by personally attending a financial institution and then by way of electronic transfer or wire transfer. There are some risks associated with providing to the third-party payer details about your trust account that would be necessary to facilitate this deposit That could include the name of your financial institution, branch or transit number, and your trust account number. As well, the method by which you are asked to provide them. Are you providing them with a void trust check, an email with that information, some sort of a form? You'll want to understand whether providing these details about your trust account could permit the third-party payor to make future deposits without your knowledge or permission, whether providing these details about your trust account would permit the third-party payor to remove funds from your trust account, whether the appropriate clearance period will apply before disbursing from these funds. So again, we know that often there's a transaction time where we wait for deposits to clear. You'll want to have an understanding of what applies in this situation. We want to understand whether your financial institution will charge a service fee for such a deposit, and if so, ensuring that the fee is drawn from your general account and not trust. We also want to understand if the service fee is deducted from the funds being advanced, determining who will be responsible for paying the fee for something like a wire transfer or bank draft that we're asked on. So watching for that, those little fees that come up, they show up on electronic transactions as well. We also want to know whether that deposit will generate the adequate source documentation required to allow you to fulfill your financial books and record keeping requirement. Often, funds deposited by these methods do not generate adequate source documents on the receiving end. So to fulfill your record keeping obligations, you want to obtain from the third-party payor a copy of the confirmation documents generated when the funds are transmitted that they receive. The confirmation should document the financial institution and account from which the funds were sent, the financial institution and account in which the funds were deposited, amount, date, and if we can get at the time of transmission of funds, to just have a complete full circle documentation of what transpired. Prior to accepting a third-party deposit to your trust account, we should confirm in advance and in writing that you are permitting the deposit of funds for that instance, and that the third party agrees to provide you with a copy of their transmission confirmation as I've just described. When we're using Interact, this requirement to provide your actual banking information is removed, so different from that third-party pay or directly going to the financial institution. However, we have different security risks around using this type of transfer. For Interact e-transfers, the documentation retained should include a copy of the email or text message notification identifying that an e-transfer has been made and received. We also want a copy of the online deposit confirmation from the financial institution, where the lawyer member should identify the client matter by number that the deposit relates to and note it on that document. It should be noted that now with these Interact e-transfers, if you choose to accept them, you can set up something called auto deposit with your financial institution, which allows for, as soon as someone puts in the email address you specify to send the funds, that the bank will automatically deposit those into the designated account, whether that's your general or trust account, depending on the email address given. However, if a client or third party sends you funds using a different email address, maybe your individual member email address, maybe your administrative or bookkeeping staff receives that email is unsecure. And whoever the recipient is of that email can obtain those funds by clicking through where would you like to deposit these and inputting whichever bank account they would like. Important to note, zero security over that when we receive that email notification. Auto deposit can correct against that. That's something we definitely have in place with our accounting firm. However, we do note that not all clients follow our instructions to the letter and emails are received by others. So important to note that ideally, if you have a setup email and you have the documentation, you want to really be strong with providing those instructions to your client to protect those funds. As well, that email address should be set up and only accessed by the person with signing authority on the bank account. So the responsible member for the trust or general bank accounts. Okay, to protect against emails coming in from others or again, clients don't always follow instructions, so having a firm policy with respect to where to forward any Interact e-transfer emails that are received out of the set course. So if it is received by a staff member, where should they forward it to? What are the steps to take from there? For indirect e-transfers, it's important to make sure that email address or text number that you choose to receive them by is not accessible by other staff. But again, you do run the risk by allowing indirect e-transfers that clients make mistakes. The email or phone should be password protected, and emails or text messages should not be sent to or from this account by others. It is recommended that in setting up e-transfers, you set up an entirely new email and or phone to receive these transfers to ensure that there's a clear separation of these deposits from other law practice emails and text messages. Electronic fund transfers and indirect e-transfers should only be made by a designated member and online banking access only maintained by that member with signing authority on the trust account. In a multi-lawyer firm, you may appoint a single lawyer to conduct all electronic banking transactions to limit exposure to additional access points to the trust and general bank accounts. But again, that's going to be a firm policy decision. Important to understand that risk when you open up with the indirect e-transfers in a multi-person firm. So some of you that are sole proprietors may think, okay, well, not a big deal. I'm the only one who gets my emails. Think though, down the road, you may grow and expand and need staff, and you'll want to ensure that it's always easier to set up appropriately from the beginning rather than try to amend after the fact. And then you have things coming into two different emails, and it makes it a little more difficult to safeguard those funds. Again, if you do want to go down that road eventually. Looking at remote deposit capture, this is a technology that gives users the ability to deposit checks remotely into an account at your financial institution without having to physically deposit or deliver the checks directly to the financial institution. For me as an accountant, I still find this mind-boggling, but many do it. Remote deposit capture provides users with the option of using their desktop computers, laptops, smartphones, tablets, or other devices to deposit checks. The benefit to lawyers, obviously, is using their mobile devices to deposit checks are time savings and convenience, not having to actually go down to the bank. However, you want to consider the risk associated with using mobile devices to remotely deposit checks, including risks related to the security, again, that accessing of the bank account, and the confidentiality of that remote deposit capture. Some of the more common risks associated with this are, 1, holding periods. You need to be mindful that the ability to deposit checks using the mobile remote deposit capture application does not mean that the funds are irrevocable. There will be a holding period before the funds are available for disbursement. So important to note for trust funds. It could take several days for the check to pass through the financial institution's payment system clearing process, and you'll want to have an understanding of what that timing is. Accordingly, confirm with your financial institution the holding periods on checks deposited by mobile capture or mobile remote deposit capture application, and ensure that those checks have cleared before you're making a check or a draw on those funds. Second risk is the duplicate check presentment. There's always a chance that errors will occur when using a mobile remote deposit capture application. For example, one check could be accidentally deposited twice, resulting in an overstatement of deposited funds in an account. This could happen in different ways. The paper check could be mistakenly resubmitted twice using the mobile RDC application, or the paper check could be deposited by mobile application and then subsequently physically deposited at the same or different financial institution. In these situations, there is a risk that the lawyer will not catch the error and will use or transfer those deposited funds, potentially putting that account into an overdrawn position once the error is identified and corrected by the financial institution. Lastly, fraud risks. Lawyers should be aware of the risk of fraud for mobile deposits of checks into accounts. For examples, could be at risk of identity fraud if your mobile device is not password protected or biometric lock protected and is stolen by an individual who knows or can access the lawyer's personal information. If the individual gains access to the information on the lawyer mobile device, the individual could log into the financial institution's mobile remote deposit capture application, retrieve your account information. This risk can be increased if the lawyer stores payment information and passwords in a digital wallet on your mobile device that is not properly protected and or uses public Wi-Fi connections when making that remote deposit. You really want to ensure you're establishing protocols and procedures in your law firm to prevent improper activity relating to remote deposit capture. This can include only using the financial institution's official mobile application to ensure that we're making use of those controls and security features, ensuring that checks deposited through the remote deposit capture application are processed through a secure internet connection or wireless network, that you're developing and implementing a process to ensure that any checks deposited are only deposited once. For instance, making the check with a deposit date to indicate that it has been deposited. So writing on that, deposited by RDC on such and such a date. Password protecting mobile devices and securing your digital wallets on that device. Making sure that you log out of the financial institution's application once you've completed your transactions each and every time. Frequently reviewing the transactions recorded in your bank account to identify any errors, unusual items, and contacting the financial institution as soon as reasonably possible if errors or concerns are identified. So important to making sure that we're on page with protecting the funds. Okay, so important. There's other items that we can use to protect, and that's reviewing the terms of your financial institution's agreement concerning the use of their RDC application, reviewing particularly the obligations, representations, warranties, and indemnities that the lawyer and the financial institution are required to provide under the terms of agreement. You'll want to review your professional liability insurance policy and or consult with your insurer to ensure that there are no coverage issues associated with the use of remote deposit capture. With respect to your books and records, if you're using RDC to deposit checks, you must add the client details to each deposit slip and maintain those slips as original source documents with their financial records, specifically documenting again the date, the law firm's bank account number, if it's not pre-printed, source of each receipt, name of the client, amount deposited. An important item to note is that although some remote deposit capture applications include a memo field that you can use to enter information about the check being deposited, it's usually limited in length or character count. A deposit slip is not automatically created using a mobile RDC application. However, an original source document with the required information can be provided through the application's deposit transaction history. We do find that each financial institution's backup looks a little different. Again, you'll want to have some understanding on what your financial institution's documentation looks like to make sure that you're getting all those details that we will require under the rules. The deposit transaction history will contain most of the information required to record on a deposit slip and usually can be printed out or maintained as an electronic copy. You should retain the originally deposited checks until they reconcile through the bank account. Automated teller machines. Obviously, we can't use ATM machines to withdraw or transfer funds from a trust account. Funds drawn from a trust account must only be by way of check or, in the future, electronic trust transfer system meeting the requirements of the Law Society. However, it may be acceptable for you to arrange for deposits into trust by use of automated banking machines. To do this, you must arrange to have all convenience or banking cards used to access the trust account encoded to allow for deposit only. Before making arrangements to use ATMs for trust deposits, you should review the banking agreement related to the machines very carefully and discuss it with your financial institution to ensure that funds deposited at the ATM are at no greater risk than if deposited in person with a teller. I know that many banks and financial institutions are pushing for the use of the ATMs instead of people, but you do want to make sure that you're checking that. In doing so, you're not putting those funds at unnecessary risks. Once you have satisfied yourself concerning the above, you still need to use and maintain your deposit book, complete the deposit slip with the required details, and then attach the receipt generated by the machine to the deposit slip, basically in lieu of that teller stamp. Debit and credit card payments, obviously something that have been around for longer than the other items we have here. And you can accept debit and credit card payments from client as long as the payments for future fees and disbursements, so trust funds, are directly deposited to your trust account. And payments for services rendered for which a bill has been delivered are deposited directly to your general account. All merchant discounts and service charges must be charged to your general account. To do this properly, yes, you would likely be required to set up 2 machines, one for trust deposits, one for general deposits, in order to strictly comply with the requirements of the rules. You should not be making all deposits to one account and then transferring the appropriate amounts to the other account. You may enter into an agreement with a financial institution or a company offering debit or credit card processing services subject to conditions. Again, you'll want to make sure that you're looking at the fees associated with in terms of making use of those. Confidentiality of the client information must also be preserved in the use of debit or credit cards. The card slip issued by the firm to the client may show the name of the lawyer or firm, its address, and the words legal services or law firm, a file number, and any other necessary code numbers, dollar amount, and date. The nature of your legal services must not be indicated. Details of the services are to be provided to the client in the usual way. Okay, some institutions or companies require merchants, including lawyers, to designate only one account into which debit or credit card payments are to be deposited. In addition, the fee charged is automatically debited from that same account. This process would not permit lawyers to receive both retainers and payments by debit and credit card. Lawyers are required to deposit funds received in trust into a designated trust account. Okay, so something to note, you also cannot deposit into trust account fees that are received, or sorry, payments that are received on account of fees for which a bill has been delivered because they are not trust funds. So consequently, the use of one account for both purposes is not permissible. You're urged to canvass financial institutions or companies to get the best agreement and process to be able to allow you to comply with the rules in full. Some members may wish to take clients' credit card numbers over the telephone and process payment of accounts that way. Although the signature of the client on the sales slip is the best proof of the client's agreement to use this payment service, accepting credit card numbers by phone can be acceptable if you have delivered the bill to the client before doing so, and the agreement with the processing company allows for this. After the payment is processed in the matter, there is the risk that the client could claim that the lawyer was not authorized to process such a payment. Lawyers who opt to process credit card payments by telephone are urged to consider implementing additional safeguards so that misunderstandings do not arise between the firm and the client, such as if we're doing things remotely, an email or some sort of written confirmation authorizing the payment on such and such a date by the use of their personal Visa, MasterCard, whatever the situation may be. Always better to safeguard.
All right, so let's start with this section of cryptocurrency with some questions. So please raise your hands if you have any experience with cryptocurrency. Okay, I see some, that's great. Now, second question, have you ever been asked by clients to accept cryptocurrency? Okay, great. So, lawyers may be considering accepting or dealing with cryptocurrency. It is important to note that cryptocurrency is not considered money for the purposes of the rules and cannot be accepted into or sent from a trust account. While the use of cryptocurrency is growing for certain transactions, it remains extremely volatile form of currency that can change exponentially between minutes or even seconds. So there is no way for a member to guarantee the value of the funds, and given the ability to or for the value to change in seconds, the amount sent from a client and then received by the member can potentially vary significantly. There is no ability to ensure the value is retained for trust purposes. Further, there is no way to ascertain where funds are coming from, which will not allow members to provide adequate documentation on their source of funds and potentially of their clients. These will not allow them to meet the rules of the Law Society of the Yukon. It is possible that a member can accept cryptocurrency as payment for services rendered. as it is the member's option to take the risk that the funds received will be other than the value of the fields billed. Now think about this and look at your screen. Look at just the volatility of Bitcoin currency, or just Bitcoin, in over just 1 year. A year ago, Bitcoin was valued at $5,800 a Bitcoin. Yesterday, when we took this screenshot, it was valued at $61,000 at Bitcoin. So just think about this. If you received Bitcoin for payment of services rendered, you could have potentially made a capital gain of almost $56,000. For tax purposes, a headache. For you personally, I mean, a fantastic gain, but always think about the volatility. It can also go the opposite way. Could have been that you received $61,000 of Bitcoin, and in less than a month or 2 months, it could have been going down to $5,000. So again, the volatility is one of the main risk factors considering the receiving of cryptocurrency. However, we do not recommend payment method, as lawyers, again, cannot guarantee where the funds are coming from. We have here the top 5 cryptocurrencies used right now. For Bitcoin, which is the most popular choice at the moment, has changed in value significantly over the past 12 months, showing just how much this means of moving funds are changing. Again, as I mentioned before, the top cryptocurrency right now is Bitcoin, and is for the fact that the owner of Tesla decided to invest $1.5 billion of cryptocurrency about 2 months ago. Since then, Bitcoin has jumped exponentially, and right now is the top cryptocurrency in the market. So some of the concerns with respect to the use of cryptocurrency are that it is currently not regulated and does not allow for verification of the deposits or payees of funds, making it difficult, of course, to comply with the Law Society, client identification and verification rules, and or anti-money laundering requirements. So this slide has, we're showing some examples of the changes in price of the type, of the top 5 cryptocurrencies over the past 12 months. As you can see, for example, Litecoin went from $37 to $247. Ethereum went from $123 to almost $2,000. And again, the Bitcoin, the most trading right now, from $5,000 to $61,000. That's absolutely insane. So while they are trending up over the past 12 months as use on these increases, the picture provides a snapshot of just how much change there can be in each, and when viewing more detail, how quickly these changes take places. I mean, these graphs are over 12 months, but if we look at it over the date, in the day, the fluctuations are exponentially as well from one end to the other end. So now we're going to be moving into fraud risks. And this is the last section of our presentation, where we're going to start looking at current fraud risks, particularly those encountered in Canada and by law practices. So fraud does not discriminate in its occurrence. And while anti-fraud controls can effectively reduce the likelihood and potential impact of fraud, the trust is that no entity is immune to this threat. Have you ever heard of the 10-80-10 principle? That is, that 10% of people will never steal, 80% could steal, and 10% will always steal. This illustrates how huge gap between the always and the never groups, and shows how there is room to quickly move from one end to the other. This movement can capture by looking at the fraud triangle. Many individuals have the opportunity to commit fraud and may even have the motive, but are often not able to rationalize the act of committing fraud. Many also have motives and are able to rationalize, but do not have the opportunity. Now, between a law firm, poor controls create the opportunity. The lack of segregation of duties, which come from allowing one person to control all aspects of the transaction from accounting, bookkeeping, and banking, handling bank deposits and bank account reconciliations, now they have complete controls over that process. Also, the lack of internal controls, which can come from not performing bank reconciliation and not having a proper retainer agreement with clear directions to pay, or records that are not kept up to date. So again, keeping on top of your law practice setup and records can help close off those opportunities. So fraudsters are going to great lengths to make their schemes appear legitimate, using sophisticated variations of client names, locations, fake documentation, and identifications, and of course, the backstories. Although there is no way to know what the next scam will look like, most demonstrate common patterns that, if identified, can help prevent fraud and, of course, loss. So some red flags can be as simple as situations where little or not legal work is required, but a large sum of money is expected to flow into your trust account. You are also going to see seen spelling and grammar mistakes in communication by companies or individuals asking you to represent them. Don't let the demand of an insistent client push you into something you are uncomfortable doing, and until all of your questions are answered to your satisfaction. We're going to go through a list of red flags, which, although they are not necessarily identify fraud, can be an indicator of problems or risks. Now, for emails, first we have generically addressed emails, dear attorney or attention counsel, emails that are sent to undisclosed recipients, or the use of the word attorney in the subject line or body of the email. 2, emails where the sender email addresses and the display name for the addressee is different. Also are emails that request the reply to be sent to a person or email that is different from the sender name or email address. Emails that give you a referral source which wouldn't or would not have your name, a website that does not list you, or a bar association you are not a member of. And lastly, individuals using a personal email account from AOL, MSN, Gmail, or several or similar free email services who contact you to do work on behalf of a major corporation or business. Now for clients who insist that email is the only way to communicate due to time zone differences. The client is overseas and known to the company and pressures you to make the case very quickly. Clients who pull or delay on promised payments of retainers when the bad check payment from an ex-spouse or loan advance arrives, they will ask you to make or to take the payment from it. Clients who, without a question or hesitation, are willing to pay hourly rates, flat fees, or contingency fees that are far higher than normal. And lastly, clients who insist on or who are not worried about shortcuts being taken. Now let's talk about payments received or checks. The issuer of the check or bank draft you receive does not make any sense given the type of payment. Perhaps a payment of a spousal support arrears by a check from a corporation, charity, or a travel agency. The check or a bank draft arrive from an address that doesn't make any sense either. It's in an envelope with a handwritten address and or without a covering letter. The payment or a loan advance is not in the form you expected or request for an amount that it is different that was expected. And lastly, expected or changed circumstances leading to the client wanting to wire funds offshore to a third party on urgent basis for reasons not related to the legal matter you are handling. Now let's take a look at a sample of a red flag email. Here, we can see a sample email with some clear issues. An known sender that we are not familiar with. Email address that looks suspect. Example, usually when you're dealing with our firm, you will see the name at sgaccountants.ca. Receive fraudulent emails that will try to look like this at glance, but when you pause and look, you see the expected pattern and what it is fraudulent email is or are different. There are 2 points in the email showing urgency. Today and right away, both attempt to get the reader to act before thinking and properly evaluating the email. Often these emails are improper capitalization or spelling mistakes that really highlight something is wrong. It may sound counterintuitive, but often these emails are computer generated or written initially in another language and poorly translated, resulting in, of course, these errors. Lastly, you may also see changes in font or incorrect sign-off, further highlighting that this email is not legitimate.
Okay, we'll look at a couple more fraud schemes, at least in brief detail, so that we stay on time today. Some current fraud schemes we're seeing again with respect to member practices are land title fraud involving owners living outside of Canada. So attempts have been made at title fraud in which fraudsters impersonated registered owners who live abroad, one of which has been successful. So risk of fraud is high right now with a hot real estate market in various parts of the country and increased reliance on technology due to the pandemic. Fraudsters took advantage of those who have lowered their guard. While the frauds detected affected owners and property managers responsible for renting homes, similar fraud attempts have been made against lawyers. Remember that with limited exceptions, if an owner client is outside of Canada, you must have a written agreement or arrangement with an agent to verify the individual's identity. If the registered owner is a company, your agent must verify the identity of the individual, instructing the lawyer on the company's behalf. You may be able to verify the identity of the company itself by directly searching a government registry created and maintained by the Government of Canada, a province or a territory or a foreign government. Be on alert that fraudsters have tried to persuade a lawyer to let them choose the agent who ends up being part of the scam. Don't fall for it. You should choose the agent and have direct contact with the agent both before and after the verification process. Even where you choose the agent, proceed with cautions. Fraudsters sometimes pretend that they met with the agent and obtained the verification documents when they did not. Instead, they or someone who is part of the scheme impersonates the agent and provides phony verification documents. Another one was random calls and emails about shelf companies. Lawyers have reported receiving random phone calls and emails from individuals who ask if they have shelf companies for sale or ask for referrals to other law firms for the same purpose. In some instances, the individual making the inquiry says they need the company to be incorporated in whichever province or territory before such and such a date to support a financing transaction or backdate invoices. In other instances, the individual says they are looking for companies incorporated before a point in time in any Canadian province or territory without providing a reason. Callers may supply a company acquisition form for the seller to complete with information about the company. They may also refer to receiving more information from their executive assistant or associate. Fraudsters may attempt to use shelf companies to deceive unsuspecting third parties into believing that a company has been in operation for a number of years, when in reality it hasn't been used since its formation. Be on guard against being used to facilitate dishonesty, crime, or fraud. In the bad check scam, fraudsters want to steal funds directly from your trust account. Instead of robbing a bank, they try to trick lawyers into voluntarily paying out funds. The bad check scam, a type of social engineering fraud, involves tricking the lawyer into believing, incorrectly, that real funds have been deposited into the trust. By posing as real clients with real legal matters, they dupe a lawyer into depositing what appears to be a genuine certified check, bank draft or money order, or even a regular check into trust. On the strength of that deposit, the lawyer then pays good funds out of trust. After the funds are gone, the lawyer discovers that the apparently good instrument is a well-made fake, leaving your trust account short, overdrawn, or both. The details of the scam, including the method of payment, may change as scamsters work to create a story that seems plausible. If a fraudster tricks you into willingly paying funds out of trust through the intentional misrepresentation of some material fact, you've fallen victim to a social engineering fraud. The bad check scam is one type, but there are others. They often have nothing to do with trying to convince you that real funds have been deposited into trust, but instead involve fraudsters pretending to be an existing client or someone genuinely authorized to give instructions on the client's behalf. Learn to identify scams. Look at phony changes in payment instructions, phony directions to pay from a senior partner, staff member, or other lawyer. And we've talked about what phony emails can look like. Similar triggers exist for those situations. Perpetrators of fraudulent schemes may try to use a lawyer or a lawyer's trust account to add credibility to a fraudulent enterprise. So, from a con artist perspective, duping a lawyer is very attractive. If one lawyer can be tricked into participating into a questionable scheme, for example, by passing funds through his or her trust account, a con artist may be successful in persuading many other people that it is legitimate. Sole practitioners and small firms and lawyers in smaller communities are most at risk for these types of frauds. Before you agree to act on any matter, obviously ask questions until you are comfortable on the legitimacy of the transaction and reason for each step you are asked to take. Remember your ethical duty, obviously, to be on guard against becoming the tool of a fraudster. While we're preoccupied with COVID-19, cyber criminals have been increasing their cyber attacks. In Canada, phishing attempts doubled in the past year. And one report out of the US indicates that phishing is up over 600% from 2018 to the end of February 2020. A remote work environment, in addition to law firms having their attention diverted to addressing pandemic related matters, potentially leaves data security matters less attended and creates potential system vulnerabilities. In Manitoba, two law firms had their entire computer systems infected with what's called ransomware. This blocked access to their computers, client lists, emails, accounting, and financial information, and all of their digital files. The firms were asked to pay an enormous ransom to regain access to their computers, which were likely attacked when a partner or email or employee clicked on a link in an attachment or email. So important to be vigilant because it can happen as quick as a click of that mouse button. Okay. Some other scams that are coming up with respect to targeting Canadians during the pandemic are those looking for login info. So scammers aren't always soliciting money these days. They might go after your personal information as well. So they're seeing an increase in scams where the perpetrators are seeking your login credentials for apps and online services, including just looking for Amazon and Netflix as a means to get into your information. One such credential scammer that they've called the Hamburglar has been hacking customers' McDonald's apps to order meals for pickup. In one case, in April 2019, a customer in Toronto was charged for more than $2,000 worth of meals ordered at different McDonald's restaurants in Montreal. In October, one customer said someone used her app to order $34 worth of chicken McNuggets and burgers for pickup at Toronto McDonald's. That's about 140 kilometers from her home. Another scam is the package delivery scam. This one's been making the rounds in Europe and elsewhere, and it's a phone or other high value item delivered to your door. Package has your name on it, but you didn't make the order. Later, a courier shows up explaining that was delivered by mistake and asks you to give it back. If you do, you're asking for trouble because the scammers might have stolen your personal info to order the item in the first place. A consumer rights expert pointed out that delivery scams are just one of the increasingly sophisticated methods fraudsters are using to leave victims out of pocket. As with credential phishing, the scam starts when the fraudsters find a way to get a hold of your personal info to place the order. Then, if they don't manage to intercept the package before it's delivered, they pose as a courier there to collect the item that was delivered by mistake and therefore verifying your information. As one victim explained, after it happened to us, we were worried about how someone was able to get so far in ordering a phone in our name. We were also worried that it could impact our credit rating, which it can. Lastly, we have ransomware meets data exfiltration scams. And this is falling victim to ransomware attacks. That is obviously a computer user's worst nightmare, as with the Manitoba firms. The term ransomware, also called malware, refers to a malicious type of software that is used to infect a computer, denying access to the system or data. Victims will receive an on-screen alert stating their files have been encrypted or a similar message, and you're demanding a sum of money to restore that information. So something to be aware of, how to protect yourself. Obviously, don't click on links or open attachments in email sent to you by someone you do not know, or if it looks like someone or a company that you're familiar with, watch to make sure that, were you expecting an email from them? Does it actually look exactly the same as a verified email from such a provider? Do not provide personal information over the phone or online to untrusted sources. Install security software suite on all devices they're using at your practice and secure your wireless router. Disable, um, uh, just watch them. You're making sure that you train and educate your staff on good security practices and restrict privileges to make sure staff can only access what they need to in order to appropriately do their job. Make sure you're backing up your system and data regularly to a cloud or removable media, such as an external hard drive that's not constantly connected to the server, and use application whitelisting to help prevent malicious software and unapproved programs from running. Develop a business continuity plan and incident response plan to make sure that you do have a plan if that unfortunate instance arises. So one of the last areas we wanted to touch on briefly was just some different mortgage fraud schemes that also are currently making the rounds. Value frauds. These are types of schemes where the value of the property or income of the borrower is artificially overstated to deceive the mortgage lender. This can be done by using flips or superficial transfers, can be used by misrepresentation of the original purchase price or of the revenue potential of income producing real estate. Approaching multiple lenders simultaneously for loans on one property, representing to each lender that the property has substantial unencumbered equity. Another tactic is to approach multiple lenders simultaneously for loans to one individual in excess of the debt service capability of that individual. This has definitely been seen in a few law societies in Canada. Private mortgage financing frauds. In these schemes, mortgage financing is raised by private offerings in which investors are promised high returns on real estate properties or projects. Returns are allegedly made possible because the managers of the scheme claim to have new projects and the ability to acquire, construct, and sell real estate developments at substantial profit, or they have the access to foreclosure acquisitions, special access to acquire such properties at prices substantially below market value. Mortgage rescue frauds are cases where fraudsters claim to provide interim financing assistance to help a cash-strapped owner avoid foreclosure in exchange for excessive equity interest in their property. And lastly, bankruptcy mortgage frauds. In these schemes, a fraudster may acquire titles, pardon me, may attach to multiple properties with no intention of paying the mortgages. The perpetrator collects revenue from the property, then files for bankruptcy to stall foreclosure and allow the scheme to continue. So, with all that bad news making the rounds, what can you do? Trust your instincts, ask questions. If a scenario makes you suspicious, question why, and don't move forward until you've answered those questions. Establish trust payment protocols. Establish protocols for transferring money out of your accounts and adhere to them, and don't allow for any sense of urgency or any of those red flag scenarios to cause deviation from the protocol. Be vigilant in relation to email. Consider implementing a policy of refusing to accept payment instructions by email, requiring instructions and changes to be given in person. At a minimum, telephone the sender to verify instructions or changes, and be sure to use a telephone number that's been previously provided and independently verified, not given to you in the suspect email. Protect your systems and data. So important to protect your computer systems and your data. Change passwords regularly and recommend that your clients and other parties to a transaction do so as well. Use secure email domains. Do not open suspicious emails and attachments. Obtain professional technical expertise to help you protect your confidential information through security measures, including antivirus software and strong passwords to detect potential security breaches. Don't help a scamster impersonate you. Regularly search for yourself online. Search for your firm name. See what turns up. check it from time to time. See what data is out there about yourself and what someone could, a scammer, could potentially have access to. Educate your staff. Make sure your staff is familiar with potential scams and ways they can come about to help you, again, protect the firm and protect all the individuals within it. Technology cannot keep up with evolving threats. New cyber risks are constantly emerging, such as cryptojacking, biometric information protection, and invoice manipulation fraud or reverse social engineering. Social engineering fraud losses are expected to rise due to increased electronic invoicing and wire payments during and after the lockdown ends. When assessing the need for cyber insurance, question used to be, do you have confidential information to protect? Yes. And how important is your network to your operations? How long can you work without access to your network? Do you have any insurance that would protect you against a significant loss? Talk to your insurer about providing some protection to those scenarios. So there are things that we can do to prevent being a victim to these people that have less than positive intentions. And unfortunately, during the pandemic, it's on the rise. So something to be aware of. And that brings us to the end of our presentation today. I think we're right on time, which it's a good thing Lynn gave us extra time for questions, if you have any. We started off with some questions, but then you've been quiet. So if you do have any, feel free to raise a hand, use the chat or question and answer area. Otherwise, Gustavo and I thank you for your time today and appreciate the opportunity to speak with you all. Again, we'll pause. I know typing sometimes, if you do have a type question, we'll pause. Otherwise, that is the end of our material. Lynn has recorded the session, and we will provide a copy of the slides out for distribution as well. And if you do think of questions after the fact, please feel free to contact us through Linda.
Can I ask a question?
Absolutely.
What happened with that Manitoba firm that had their computers with the?
I believe they contacted the police, and I don't know what ultimately the damage was to the practice. They were definitely without their information for a period of time. And I don't know what the ultimate loss of information was, but it was a small nightmare, and it did take them some time to deal with appropriately.
Thank you.
Oh, Grant has a question. Not a question, but a comment. Excellent advice, Grant. Advice on emails. If it looks smelly, delete it. If it's real, they will communicate again. 100% Grant. Such an important thing. I know with our clients, they constantly get the CRA is trying to contact me from, through my phone, and it's there's so many scams involving the CRA that accountants have had to deal with. But so important. If it looks or sounds or smells wrong, delete. If they really want you, they'll find you. Tanya, you had a question? Okay, RBC is only allowing e-transfers to one account at a time. And so that's exactly where you have to make a decision as a law practice about how you would like to set that up. If you do want to accept, if it makes the most sense to allow the e-transfers for trust purposes or to allow them for general purposes, as well as making sure you have adequate documentation. So important to work with that, or like I said, it's important to understand what options are out there, and definitely every financial institution is different, both in what they allow, but also what documentation is available after the fact. Some banks allow you at any time to access the confirmations for all Interact e-transfers sent and received. Others, you have to actually ask them, and the problem with that is, again, Interact's a third party. So any of you using that Interact e-transfer system, there can be a significant delay if you need to get that backup, because you have to go through a third party, which takes longer and can be expensive. So understanding from your financial institution how quickly you can get backup or what is already available through their online systems. Any other questions? Again, we're here for a few moments. I think if anything significant comes up, that can be communicated as well through the skipping to the end of the recording. What is the main area we see law firms make mistakes? The biggest thing we see is not appropriately preparing and reviewing trust reconciliations on a timely basis, and therefore, not catching errors in a timely fashion, and or not correcting those errors in a timely fashion, and then they just build up over time. And so what becomes, small dollar little problems that on the face don't look significant, they cause issues with respect to that balance held in trust, and or just the accuracy even on the general account side of things. The second thing we see is members not giving as much attention to those general law firm records as to their trust records. And again, we would posit that it's always important to address both sides of things. Your business people as well. It's important to keep track of those funds. I know you get busy, and it's important to give credit to both of those types of transactions. And then the third thing I think we would see is, and I do see some of your experienced Yukon bookkeepers here on the call, but it's not recognizing when you do need that assistance. And a business law practice can really benefit from the knowledge of those bookkeepers that have the experience and understand these role requirements, as well as bookkeeping generally, and can really help take that load off of busy members. And we'll find sometimes that sole practitioners trying to do absolutely everything in their practice. It's hard. It's a lot of work, and we see it best to focus on the practice of law and allow that support for what you're able to do. Oh, Linda posted another good point here. Is what question that comes up often is, how can members address small amounts left in trust where the client doesn't cash the check? And this is a constant frustration in any law audit. I think a law firm audit we've done, and the process is always to try and contact that client. If you can get a hold of them and ask them to please either cash the check and or send back that check, and you'll get them a new one. That's the ideal practice. A lot of times we can't find that client. Then your process is to document your attempts to contact that client. If you can't any longer, or you can't find them no matter what, it's been, the Law Society rules allow a period of 2 years. You can't get anywhere. Keep that documentation on hand, and then you can cancel all of those checks and forward the funds to the Law Foundation. There's not a quick and easy way, unfortunately, to deal with those balances. And that's one of the things, again, going back to Gustavo's review of your bank reconciliations, even if you are performing them yourselves, is taking a pause and doing that review to kind of question the information that's there. Tackling those small balances when they're current, so important. Getting that follow-up within 30 days. Oh, it's been a month. Most people, they get a check, they put it in the bank. If it's been 30 days, if it's been 60 days, get on them right away. Deal with them while they're current, instead of leaving that them to become stale dated. That's being diligent with the follow-up on the information that is contained in your bank reconciliations is so important for keeping your records clean. Any other questions out there? And again, we are available via Linda if questions do come up in the future with respect to your trust and general accounting. We're here not just as auditors, but to support. Another question, if this was addressed, can I refund trust money to a client by e-transfer? Technically, the rules at the moment do not permit specifically the e-transfer out of trust, but practices are using that indirect e-transfer. And so if you do choose to do that, you could go down that road, as long as you are confident that you can get that documentation that has that same information, date, who is the funds going to, getting that unique confirmation number from the financial institution, agreeing with the client ahead of time with respect to a confidential password for that transaction, amount, purpose, all those details. Keep all that documentation. Best practice is keeping a copy of the email as well as that screen print from the financial institution with the confirmation number for those funds. And again, the Rules Act are being updated. The pandemic delays things, as we all know, but it will be coming up, and we've spoken with your audit committee and Linda about these types of best practices around doing that, because obviously the electronic transactions are there. There's a convenience, and so hopefully, taking in consideration the risks we've discussed today, there are ways to conduct those by putting those safeguards in place. It is one thing we do recommend as well is keeping abreast of some of the other law societies. I know Yukon provides you with updates, but Law Society of Ontario, Law Society of BC, Law Society of Alberta all do a lot of educational material on their websites with respect to some of these different scenarios. Law Society of Ontario has a whole series of sort of podcasts that go through a lot of these different scenarios to provide some tips. Can be helpful to direct staff to if you're looking to educate others in your firm about some of these areas. There is a lot of free information out there to help learn about these areas further. And or if requested, we'd be happy to come back and speak again in more detail on any of these items. Okay, well, that looks like that's the end of our questions. So I think we'll close out the session. Thanks everybody so much for your time today. And you might be seeing us in the future. Some of you are as auditors, or sorry, I should say some of you have. So good to see you here. Thank you.
Thank you to both of you. And on behalf of the CLE committee, I want to thank you for this great presentation. It was very informative, and I'm sure you'll be receiving more questions from the bar.
Thanks, Megan.
Thank you very much, Megan.